CBRE Group just dropped a Q1 2026 print that should have sent the stock flying. Core EPS of $1.61 absolutely crushed the 113 consensus estimate cold.
We're talking about a 42.5% upside surprise. Revenue hit $10.5 billion, beating by $297 million. Operating income jumped 82% year over year.
And yet the stock fell 2.9% on the print, closing at $149.15. That leaves shares sitting 14.4% below the 52-week high of $174.27.
Which tells you everything about sentiment in commercial real estate right now. The world's largest CRE services firm beat by nearly 50 cents, and the market shrugged. That disconnect is the whole story today.
CBRE is a $44 billion market cap business with 140,000 employees operating in roughly 100 countries. It's not some speculative name. It's infrastructure for global property markets.
Today we're digging into whether this Q1 blowout marks the real inflection in the transaction cycle, or whether tariff fears and office sector worries keep capping the multiple at 18 times forward.
We'll walk through the segments, the bull and bear cases, peer valuations, and exactly what to watch in Q2. I'm Alex, he's Sam, and this is Charged Alpha.
CBRE Group is the world's largest commercial real estate services firm. It was founded in 1906, making it older than most of the buildings it leases. Headquarters sit in Dallas, Texas today.
The business operates across three distinct segments that actually balance each other really well. Advisory services brings in about 37% of revenue, and that's the headline, cyclical piece everyone watches.
Advisory covers leasing commissions, capital markets brokerage, property sales, and valuation work. When deal volume drops like it did in 2022 and 2023, this segment takes the biggest hit on earnings.
Then you have Global Workplace Solutions, known as GWS, which is roughly 50% of revenue. This is facilities management, project management, and outsourced corporate real estate services for massive multinational clients.
GWS is the boring, beautiful, recurring revenue engine. Long-term contracts, predictable margins, sticky enterprise relationships. CBRE bought this business from Johnson Controls back in 2015, and it completely transformed the model.
The third leg is real estate investments, or REI, at about 13% of revenue. That includes CBRE Investment Management, Trammell Crow Development, and the CBRE HANA Flexible Workspace platform.
The Turner & Townsend acquisition completed in 2022 added serious project management and data center construction expertise. That deal is paying off huge right now, as hyperscaler CapEx keeps accelerating globally.
So you've got cyclical brokerage, recurring facilities management, and investment management all under one roof. Beta runs 1.348, meaning it moves more than the market, but not dramatically so.
Robert Sulentic has been CEO of CBRE since 2012, so he's coming up on 14 years running this company. He's also the president, meaning he owns operational execution completely.
Sulentic didn't come up through traditional CBRE ranks. He joined in 2001 through the Insignia Financial Group acquisition, bringing deep property industry experience from that merger into the combined entity.
His tenure numbers are genuinely remarkable. Revenue grew roughly $7 billion when he took over to around $40 billion today. That's nearly a 6x expansion over his time as chief executive.
Two acquisitions define his strategic legacy. Buying GWS from Johnson Controls in 2015 pivoted CBRE from pure brokerage into recurring contracted services at enormous scale across global enterprise clients.
Then Turner & Townsend in 2022 added project management capabilities right before the data center boom exploded. Timing on that deal looks increasingly brilliant given the current hyperscaler build-out cycle underway.
The CEO quote from the earnings call hit all the right themes. Sulentic said the results reflect the strength of their diversified business model, highlighting leasing recovery alongside resilient GWS and data center project management.
Let's walk through the financials because the quarter was genuinely exceptional. Core EPS of $1.61 versus $1.13 consensus, a 42.5% beat on the bottom line.
Revenue came in at $10.527 billion against the $10.230 billion estimate. That's $297 million of upside, or about 2.9% better than the street model.
Operating income was the real standout at $511 million. Compare that to roughly $280 million in Q1 2025, and you're looking at an 82% year-over-year jump.
GAAP EPS printed 107, so the gap between core and GAAP is 54 cents. That's goodwill amortization from the acquisition history, and it's a number we'll revisit in the bear case later.
Breaking down segment dynamics, advisory services clearly benefited from the leasing and capital markets recovery. GWS kept delivering its steady contract-based revenue, and project management within Turner and Townsend continues posting robust growth numbers.
The trailing 12-month revenue sits at $40.6 billion, up 13% year over year. That's accelerating growth at scale, not the kind of deceleration you'd expect from a mature services business this large.
Margin profile tells the services story. Gross margin 35%, operating margin 3.8%, net margin 3.1%. These are pass-through heavy businesses where scale matters enormously.
Return on equity landed at 13%, which is solid for a capital-light services firm. Price to sales of 104 times reflects premium positioning versus the other real estate services peers we'll discuss shortly.
One quarterly quirk worth flagging. Operating cash flow was negative $825 million in Q1, but that's pure seasonal working capital build. CBRE always consumes cash early and generates it later in the year.
Annual free cash flow still runs around $1.4 billion, and management deployed $530 million in buybacks during Q1 alone, which is a very aggressive pace for capital return this early.
Looking at the EPS trajectory, full year 2022 printed $3.80, rising to $4.50, then $5.60, then $6.80 last year. Consensus now targets $8 flat for full year 2026.
Sell-side analyst coverage is genuinely constructive on CBRE heading into this print. The breakdown shows 12 buy ratings, 5 holds, and just 1 sell rating across the covering analyst community right now.
The mean price target sits at $190 per share. With the stock at $149.15, that implies roughly 27% upside to consensus, which is meaningful room if estimates actually hold.
Big names in the buy camp include Barclays, JP Morgan, Morgan Stanley, and UBS, all with buy or overweight ratings. These are not small boutique shops. These are bulge bracket firms with institutional client bases.
The forward multiple math is where things get interesting. At $149.15 on $8 of consensus earnings, CBRE trades about 18.6 times forward, which looks quite reasonable.
Full year 2026 consensus revenue sits at $43.5 billion. Looking out to 2027, the street models $49.7 billion in revenue and $8.68 in core earnings per share.
Q2 2026 specifically, analysts want $1.49 of core EPS on $10.37 billion of revenue. Those estimates are almost certainly getting revised higher after yesterday's Q1 beat.
The preprint consensus for full year was actually $7.54. After this 48-cent Q1 upside surprise, we should see estimates marching toward or beyond the $8 level fairly quickly.
So the bottom line on street positioning, analysts like the name, price target implies real upside, and revision momentum is just beginning to build. That's a constructive setup for longer-term holders.
Now let's walk through the bull case for CBRE. And honestly, there are 5 distinct arguments that stack on top of each other pretty convincingly after this Q1 print.
Bull argument number 1, the commercial real estate transaction cycle is finally turning. Capital markets were deeply suppressed through 2022, 2023, and most of 2024. Q1 confirms real inflection.
Bull number 2 is the data center mega tailwind story. Turner and Townsend sits inside a $200 billion plus hyperscaler CapEx pipeline, providing project management for the largest build-out in infrastructure history.
Bull number 3, the GWS recurring revenue floor, roughly $20 billion of sticky contracted facilities management revenue that pure brokerage peers like Cushman simply don't have on their income statement at all.
Bull number 4 is post-beat estimate revisions. Preprint consensus for full year was $7.54. Revisions toward $8 plus are underway now, and that momentum typically extends for multiple quarters afterward.
Bull number 5, the buyback machine is genuinely impressive. $530 million returned in Q1 alone, roughly a 5% annualized repurchase yield, with zero dividend competition for capital allocation priority.
Put those five together and the thesis writes itself. Cyclical recovery plus secular data center growth plus recurring revenue plus estimate revisions plus aggressive buybacks equals compelling multi-year compounding potential.
The forward multiple of 18.6 times is not expensive if earnings actually compound from $6.80 last year to $8 this year to $8.68 next year, as the street currently models.
And if advisory services continues recovering through 2026 and 2027, there's room for both earnings beats and multiple expansion. That's the classic double-engine setup bulls love to find in cyclical names.
The enterprise value to EBITDA multiple runs 18.76 times, which reflects the quality and diversification premium. CBRE earns that premium through scale, segment mix, and proven management execution over cycles.
All right, time for the bear case, because no thesis is complete without honestly stress testing the downside. There are 5 specific concerns worth taking seriously before you get too excited here.
Bear argument 1. The commercial real estate market sensitivity is real. Advisory is 37% of revenue and highly correlated to transaction volume. The 2022 and 2023 repeat scenario historically cuts EPS by $1.50 to $2.
Bear 2 is tariff impact on construction activity. New tariffs could delay data center projects, pressure hyperscaler timelines, and shrink the fee backlogs at Turner & Townsend that bulls are counting on heavily.
Bear 3, the gap versus core earnings gap raises quality questions. 54 cents per share comes from roughly $7 billion of goodwill amortization. Skeptics argue core earnings overstate true economic profitability.
Bear 4 is the office sector's structural ceiling problem. Remote and hybrid work permanently lowered gateway market office demand. Leasing economics in New York, San Francisco, and Chicago may never fully recover.
Bear 5, the leverage profile deserves scrutiny. Net debt sits at $6.29 billion, running about 4.5 times free cash flow. That's manageable now, but tightens quickly in any downturn scenario.
Add on $7 billion of goodwill on the balance sheet, and you have real impairment risk if a recession arrives. Goodwill write-downs wouldn't hit cash flow directly, but they crush GAAP earnings.
The counter to every bear point is diversification through GWS and Turner & Townsend. But bears argue that diversification has already been priced in at 18.6 times forward earnings and 104 times sales.
Another bear angle is the negative Q1 operating cash flow. Management calls it seasonal working capital build, and historically that's been true. But bears watch that line carefully in any cyclical slowdown environment.
If you're skeptical on the CRE transaction cycle timing, if tariffs extend, and if office keeps shrinking, then this multiple looks rich relative to the actual achievable earnings trajectory ahead.
Let's put CBRE in context against the direct peer group because comparative valuation really matters in a services business like this one. The peer set includes JLL, Cushman, Newmark, and Colliers.
CBRE trades at 104 times price to sales with 13% revenue growth. JLL sits at 0.68 times sales with 11% growth. That's the most direct large-cap comparison right there.
Cushman & Wakefield trades at just 0.25 times sales with 6% growth. That massive valuation discount reflects lower margins, weaker GWS exposure, and a much more levered balance sheet profile overall.
Newmark runs 0.80 times sales with 15% growth, which is actually the highest peer growth rate. But Newmark is smaller and more exposed to capital markets timing than diversified CBRE.
Colliers International trades at 0.90 times sales with 12% growth. Colliers has built out a nice investment management business, making it structurally the closest philosophical peer to CBRE's integrated model.
So CBRE commands a clear valuation premium across the entire peer group on a price-to-sales basis. The question is whether superior segment mix and scale justify paying that premium today.
Turning to positioning signals, options market activity around the print showed elevated implied volatility, which typically happens into earnings for cyclical names like CBRE, with meaningful beta exposure.
Implied volatility usually crushes after a print regardless of direction, and that likely happened here given the muted 2.9% downward stock move despite the massive earnings beat delivered.
On the insider side, there haven't been recent high-conviction buy signals reported, which isn't necessarily bearish for a company aggressively buying back stock. Management often prefers corporate repurchases over personal open market purchases.
The $530 million in Q1 buybacks functions as a corporate insider signal itself. When the company is buying at this pace, insiders rarely need to add personal positions on the open market concurrently.
Option skew heading into Q2 will be worth watching closely. If downside puts get expensive relative to upside calls, that tells you hedgers are pricing in further CRE cycle disappointment ahead.
So here's the bottom line on CBRE Group after this Q1 2026 print: a genuinely strong beat, muted stock reaction, and a setup that depends heavily on sustained CRE cycle recovery.
For the bulls, you have cyclical inflection, secular data center tailwinds, recurring GWS revenue, aggressive buybacks, and estimate revision momentum. At 18.6 times forward earnings, the valuation math works.
For the bears, you have office sector structural pressure, tariff risk on construction, gap quality concerns, 4.5 times leverage, and $7 billion of goodwill that could face impairment risk.
The verdict depends on your conviction around the transaction cycle inflection. If Q1 was the real turn, CBRE compounds nicely from here toward the 190 mean price target analysts currently model.
If Q1 was a head fake and tariffs or office drag pulls advisory revenue back down, you could see meaningful multiple compression layered onto earnings disappointment. That's an uncomfortable combination for any cyclical name.
For deeper analysis and our full position tracking across the real estate services complex, head to chargedalpha.com, where we break down every print in detail with our subscriber community.
The key metric to watch for Q2 2026 is advisory services revenue and operating income hitting $1.1 billion or higher. That number kills the easy comparison objection from skeptics immediately.
Second key watch item is Turner and Townsend backlog growth. Management commentary on data center project wins and hyperscaler CapEx momentum will drive the forward narrative for the entire fiscal year ahead.
Third thing to track closely: any commentary on tariff impact to construction timelines. If management signals delays or cancellations, the bear case gains significant traction against the secular growth thesis quickly.
Fourth and finally, watch full-year guidance trajectory. If management raises toward $8.20 or higher in core EPS, that signals confidence in sustained cycle recovery through the back half of 2026.
That's our deep dive on CBRE Group's Q1 2026 earnings print. A big beat, a muted reaction, and a genuinely interesting setup heading into the rest of this commercial real estate recovery cycle.
If you found this useful, hit subscribe and drop a comment telling us whether you're Team Bull or Team Bear on CBRE at 149.15. We read every comment and respond to as many as possible.
Next episode, we'll be breaking down another major earnings print with the same structured framework: cold open, company overview, numbers, bull and bear, peers, and the bottom line. That's the Charged Alpha way.
Thanks for listening to Charged Alpha Podcasts. I'm Alex, he's Sam, and we'll catch you on the next one with fresh analysis, sharper takes, and hopefully another earnings print worth arguing about together.
Quick disclosure before we wrap up. This podcast is for educational purposes only and does not constitute financial advice. Nothing we discussed should be interpreted as a recommendation to buy or sell securities.
We may hold positions in the stocks discussed on this show. Always conduct your own research, consult a licensed financial advisor, and make investment decisions based on your personal situation, goals, and tolerance for risk.
All data is for informational purposes only and was accurate at time of recording. Markets move fast, and figures may have changed since. Thanks again for tuning in to Charged Alpha Podcast today.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street